Today I say I am terrified on the show. And Daniel Goldman says, there was an emotional brain long before there was a rational one. No kidding. Welcome to the show. My name is Roger Whitney. I am your host. And this is the show dedicated to helping you not just survive retirement, but have the confidence to rock retirement, even in a bear market. Imagine that. We're going to talk about being terrified, how to navigate a bear market, and then we're going to have Tanya Nichols, an excellent retirement planner from Align Financial, on the show to answer some of your questions. Before we do that, though, a couple things. Number one, I want to encourage you to go to sixshotsaturday.com or rogerwhitney.com and sign up for our weekly Saturday morning email, because that is where you're going to get one email a week that will share links to resources that we mention on the show, summaries of our answers to questions, and I always share some tips and things that are going on that I think might be helpful. But the other reason I would suggest that you do that is it's a great two-way communication, because when you get this email, you can hit reply. And if you have a thought, some criticism, some compliments, some ideas, you hit reply. It comes direct to me. And it'll give us the opportunity potentially to have some one-on-one chats so we can have this be a little bit of a two-way street. So go to sixshotsaturday.com for that. Second, we had some feedback from our conversation with Amy Bloom on her book and her journey with her husband in his committing assisted suicide due to some terminal health issues. And I think it was a couple episodes back. We'll have a link to it in our Six Shots Saturday email. I got a tip, I got a positive feedback, and I got a negative feedback. So I just thought I'd share that to continue that conversation. First is the tip from Bob. Bob said he just got done listening to the conversation, and he said that she and her husband demonstrate great thoughtfulness and foresight and bravery in their approach to the end of his life. What a remarkable couple. He said, thankfully, most of us at end of our lives are going to have much more mundane journeys, but we still need to be prepared. And Bob says he has been a family doctor in Vermont for 30 years and wanted to share some thoughts around end-of-life care from his experience. And no doubt over 30 years, he's had a lot of experience in this. He had three things to share. Number one is it is important to have a durable power of attorney for healthcare. It's a simple document that designates a specific person to make legal decisions for an individual when they become incapacitated. Clinicians are morally and legally bound to respect those decisions. So it's an important document. Second, ask your doctor if they will be willing to follow your wishes when the time comes. That way you can confirm that they don't morally or ethically have some qualms about what your wishes are. Probably important to know. And he says, third, when the time comes, if things become complicated, consult with a doctor specializing in palliative care. These specialists help people to identify a person's goals for the remaining of their life, get the care they need to manage their systems, get the support they need and their family needs to navigate a complex healthcare system. Thank you, Bob, for taking the time to share some of your wisdom. Our second is a positive feedback, and we got mostly positive feedback on the discussion of this topic. This comes from Lauren. She said, thank you so much for this week's podcast. The interview with Amy Bloom was great and important. I can't think of another place, podcast, TV show, article, where I would have heard about her book and heard a quality discussion on the topic. Many thanks. Well, you're welcome, Lauren. I did get a couple very negative feedback emails. I won't read them on the show. I responded to them respectfully that were a little disgusted that I would bring this topic up in terms of whose life is it and what kind of slippery slope this could be. And I understand that to a point. And I appreciate their taking the time to share their feedback with me. And so to address that, but everything on the show, as this show has grown and over 8 years, we've delved into other topics. I view this show as we're not afraid to talk about topics. All of us are working to flush out our understanding of what it is to retire, obviously financially and non-financially, but also what it is to age and the kinds of issues that we're going to be facing over time, right? We've never done this before, have we? And we've seen how maybe parents or other people have done it, but our retirement is going to be different than any retirement in history. And so my philosophy around this is to find topics I feel that are important or people are telling me are important, and then to do a theme or explore those topics from the standpoint that I'm curious and I'm trying to refresh or flush out my thinking on this topic. So this is a very selfish affair in some ways for me, is like take this topic we're talking about here with Amy Bloom. I don't think much about this. And I've had clients that talk about, when that time comes, this is what I'm going to do. All those, very trite off the cuff things. But I want to flush out my thinking on this. And I know where I stand. And I'm guessing you have an idea of where you stand, but it's good to recheck your thinking and be curious. So I take the Ted Lasso approach in this. I'm always trying to be curious. I'm not trying to be judgmental. If I think it's something that we should probably think about, or at least understand better. So thank you for all the feedback. This is one thing I love about 6 Shot Saturday is that people reply and they tell me stuff. Sometimes good, sometimes bad, sometimes helpful, sometimes not, but I always take it as they're trying to be helpful. So I want to be respectful of that. So thank you so much. Now, okay. Before we get to our questions and answers, let's talk about why I'm terrified. I'm using that word because in one of the answers to a question from Tony, I use the word, he says terrified in his question. And I sort of say, yeah, I'm terrified too. But I don't want to overstate that. Last I looked, the Nasdaq stock market, which is more technology stocks, was down 32% from the high. The S&P 500 was down 22% from the 52-week high. Bond markets are down price-wise because yields have gone up. So even if you had a bond stock portfolio, you're feeling it on both ends. And every day I get up, I don't know about you, when I take a look at where things are at market-wise, it's worse. And when I do read, whether it's the Wall Street Journal or The Economist or the select things that I try to pay attention to, it doesn't paint a really positive picture. It's easy to be terrified when I see the value of my accounts going down, when I see the value of clients' accounts being impaired, going down, when I read the things that I choose to read, which I think are very thoughtful, and it still doesn't look that bright. I can't imagine what it must feel like if you're reading just stuff on the internet. It's got to be terrifying. And I think the most terrifying part, and again, we're using a strong word there, I don't want to somewhat in jest, is that we don't know what's around the corner. We don't know if this is the prelude to the Sanford big one, right? Oh, it's the big one. I don't know. You don't know. Nobody knows. And so I don't think we can spend a lot of time trying to figure that out, because if we would have gone backwards in time, 6 months, 7 months, 12 months or longer, everything was rosy and we were all much more optimistic about markets because we had been making money. And the news media, which is generally, at least on the internet, a reflection of our feeling, was generally positive. Now we're much more pessimistic and worried, and the internet is a reflection of our feelings. It exaggerates our feelings. It doesn't inform them. But nobody knows what's going to happen. That's one reason why we don't dive into forecasts and market predictions, etc., because nobody knows. There's nobody to put a lot of stock into in calculating those things. It's better for us if we're terrified or if we're worried to acknowledge that, hey, we're emotional beings. We are rational to a point, but we are emotional beings. That's who we were long before we were rational or had rational thought. Acknowledge that. Don't try to eliminate it, and build frameworks to manage that so we can think thoughtfully and not overreact one way or the other. Yes, overreacting when we sell and bet when we're afraid is potentially disastrous if things rebound. But it's the same on the opposite extreme. When we're really optimistic, it's easy to overstretch and be too aggressive, and that can be just as disastrous or more. I acknowledge my emotions. I get afraid. When I'm chatting with clients and we're doing triage, are we still on a good path? I'm afraid because I don't have all the answers. I want to have all the answers. They're afraid because they're not working. This is all they got, and they have a life that they want to live. And the only way that we work together on that is to have a framework, which we talk about all the time, of mapping out, this is where we want to go. And we've thoughtfully put that together. And this is how we're going to get there. And then when good things happen, we look for opportunities to make that more resilient. And when bad things happen, we keep checking, is this still a safe path? What are incremental things we can do to shore up our path and our position to get to the life that we want? Then you can't do that in a calculator. You can't do that in a spreadsheet. And the more you optimize things and put optimization in trying to inch out every single dollar, the more fragile you make the entire system to breaking when things go bad. And this is why we always put optimization in the planning process at the end. So if you're terrified or afraid, first step is go back to, well, let me revisit my plan of record. Let me revisit my plan, which should have, this is where I said I wanted to go. Here are my resources at the current levels. Is this plan still feasible? And is it resilient? And if not, what little things can I do to make it so? And it's never a binary or singular thing of sell it all or buy more. It's generally a number of things that you do in smaller fashion. That is a process, and you have to stick with your process, assuming you feel like it's well thought out. Now, if you don't have a process, perhaps you've been in accumulation mode, which has been, I'm just buying all day long and taking as much risk as I can, which is not a bad strategy, not a bad process when you're young. But as you get older and you get closer to needing the money, the process needs to change a little bit. And so perhaps you're mismatched or you don't have a process at all. I can understand why you're afraid or terrified. Step one is find a process and build, starting at the beginning, a plan so you can evaluate, are you actually okay or not? That way it won't get rid of the emotions, and I don't want to get rid of the emotions, but it will help focus us on taking lots of little incremental action that is proactive. Just through that alone, it's going to bring down the stress level because you're not just randomly grasping for ideas. You're following in an incremental fashion a protocol which will ground you. Some of this thought, by the way, we have a question from Tony that Tanya and I address, and we've already recorded that, and I've been thinking about it, and so I wanted to give more thought to that. And then next week, we'll talk a little bit about how do we manage, how do we do some self-care, because it's not just the markets. I know people that are getting laid off. There's stressors coming from everywhere, so we're going to have to fight burnout, and how do we maintain ourselves during this, which is an important part too. So with that, let's get on to answering some of your questions. Today's show is sponsored by LTCI Partners. They are an independent insurance agency, which means that they can survey many different insurance companies in helping people navigate whether long-term care insurance is right for them. And if you go to www.ltcipartners.com/RAM, you can actually take a quick questionnaire to see if you're even able to get long-term care insurance with some very basic health questions. And then they'll send you some indications of what the range of cost is for traditional insurance as well as hybrid insurance. So if you're navigating how to manage the long-term care risk in your retirement, I think going to www.ltcipartners.com/RAM is a great place to start. All right, let's get to your listener questions. And we'll be doing another listener question focus theme, by the way, in September. So keep them coming. And we're going to do something we haven't done in a while. And we're going to bring on a guest to help me answer questions because I've been doing this all month. I'm getting tired. So we're going to bring on someone who hasn't been on in a while. We don't have a nickname for you yet, do we, Tanya?
We don't.
What should it be? What are you? Oh, you can't nickname yourself. That's not allowed. So you are the tenacious Tanya Nichols because you are tenacious.
Okay.
All right.
I can live with that. I've been called worse.
That's a good one. That's a good one. How are you doing over there at Align Financial?
Really good. Just was on vacation last week for the 4th, actually. Took my kids to the lake.
Yes, they have lots of lakes in Minnesota.
They do. My son caught his biggest walleye ever, 24 inches. He was absolutely thrilled.
Is that the one that you texted me?
Yes.
Yes. Nothing.
Yeah.
There's nothing better than the face of a child that has caught a fish.
Right.
It's just amazing.
Especially when it's half as tall as they are.
Exactly. All right. So we have some listener questions for you to help me answer. If you have a question for the show, you can go to rogerwhitney.com/Ask Roger. And we are bumping audio questions to the front of the line. That's the fast pass. We've initiated that because we'd love to hear your voice. That said, we're not starting with an audio question. So our first question comes from Richard about claiming Social Security based on an ex-spouse's Social Security benefit estimate. So Richard says he's about to be 62. During their marriage, his wife earned 2 to 3 times more than him in any given year. And based on his calculations, it looks like even if he claimed the spousal benefit age 62, it would be more than his benefit even at full retirement age. And so, Richard, with the income profile you described, it is quite possible that claiming your ex-spouse's Social Security at age 62 might be a larger number than claiming your own at full retirement age or at age 70. That's not the only option you have. So you have that option, claiming based off of your ex-spouse's record at age 62. You could also delay your decision and claim on your ex-spouse's record at full retirement age, because that will continue to accrue up to full retirement age, or delay even longer, and then it would be claiming on your own benefit up to age 70, because the spousal benefit will not increase after your full retirement age. So I would evaluate those 3 options: claiming on the spouse's record at age 62, at spousal record at full retirement age, or at yours later in life. And I would definitely set an appointment with the Social Security Administration. They have local offices and have as much information as you have so you can compare which benefits might be best for you. So you're smart to remember that you have this, and I would just go through it systematically, and I would go to the Social Security Administration or build your own spreadsheet using the data that they give you. All right, Tanya, and this is from Tony, and I'll just read it to you and you can take a few notes and then we can answer it. It said, "Hey, Roger, really enjoy your show. My question is about the current market volatility. It seems that advisors always give the same advice no matter what is happening in the market, and that is stay the course. Oftentimes, the market has returned 10% over the last 100 years, they'll add in. Unfortunately, most people don't have 100 years to hope everything works out." So true, Tony. "I've watched a good portion of my portfolio disappear this year, and it's terrifying. At what point do you suggest people do something different? What levers do we have to pull? I'm 51. I have some time to recover, but I still feel like I should be doing something to mitigate losses. Meanwhile, to continue to pump money into my 401k, and I feel like a sucker, watching my retirement get further and further away. I'm a data guy. Are there some numbers that will help me feel better than just stick it out?" So Tony, I'm going to phrase it. So he's 51 years old. Sounds like he has, let's call it 10 years to retirement. And you see in his portfolio disappear and he feels like a sucker. There's got to be something different. I'm guessing you might have had versions of this conversation recently.
Definitely a few. I imagine you had quite a few yourself.
Yeah. So I'm interested in how you navigate them. Do you just tell people to stay the course?
Well, I think for Tony specifically, with being still a few years out, one of the first things I would suggest to someone like him is maybe, in order to get context, to look back at what he's experienced in the past himself. Don't just take our word for it. Maybe even look at, sometimes I'll pull my clients' account values from 10 years ago. If they've been with me a long time, for example, I'll just pull out an old statement and show them what has happened in 10 years. And I think that kind of historical context relative to your personal situation is really, really helpful when it feels like the sky is falling and how could it possibly get any better from here. Now, I do give the advice of stay the course. We do off-cycle rebalances, which you talked about last week on the show, where if the market's down by more than 20%, we will take some action and rebalance. But we're really not doing anything. We're not trying to beat this thing by any means. So my tips for Tony, and I've done this with lots of clients, is we do our best to talk about what's really happened in the past when we've been faced with similar fears about the external environment, like the economy or inflation or global. I remember in 2011, for example, when Greece, they were filing bankruptcy, and the US at the time, our debt was being downgraded. Right. Greece was defaulting. Thank you. And I remember that was one of those times YouTube was actually showing videos of journalists and just regular human citizens, civilians, being attacked and murdered by terrorists on YouTube. That was like the first time that was really becoming a thing. There was nothing in 2011 that felt like things were going to get better from there. So I'll bring clients back, and I'd offer to bring Tony back too. Think about all the times in the past 5 years or 10 years or 20 years in which it's felt like there's absolutely no way this could possibly get better. And then be reminded that it does. And there's some data, and if you Google this, I'm not going to be able to get the numbers quite right. But if you miss those first days of the recovery, it's usually just a few weeks. It's a short time. If you miss those days, you don't recover as quickly as everyone else does. I've seen so much data that proves that if we just sit still and if we have a really good understanding of our cash flow and how much money we need from our portfolio now or later, that's really the best outcome when we're facing uncertainty. This is definitely an uncertain time.
Yeah, it's like driving in fog. You don't know what's around the corner, and it's nighttime and it's scary. So Tony, I think those are all great frameworks for how do you approach this. What did you do when we had the COVID bear market? Did you feel this way? What was your experience, Tony, when you were going through 08? Because you're old enough to have gone through that with having some money. True, you were younger. So you want to examine, how did you navigate those? Did you have this same feeling, and did you go to cash, or did you just ride it out? Because that will give you some sense of perspective. And I like the idea, Tanya, and this is what I do as well, Tony, is my benchmark with clients, especially in the accumulation phase, is, well, in all phases really, is their net worth statement. Because the values of things are going to go up and down, just like a housing market. If we have a big housing downturn, we feel differently about the value of our house. Like my house went from, I don't know, I bought it at 300-ish. I think it's worth 600-ish. It could go back down to 400-ish. I don't pay that much attention to it. And maybe it's because I live in it. If I were to sell it, that might change the perspective. But I definitely don't think I need to give you numbers on this, Tony, because you're a numbers guy. You can go find the numbers. When you use words like terrifying, that's not a quantitative perspective that is impacting you. So my question for you, Tony, would be, what is the timeline that the monies invested are for? And if you didn't have this feeling in the past, it could be because you're getting closer to retirement, so you're seeing the end of the finish line, right? And I think definitely the strategy has to change as you get closer to the finish line, because your time horizons change, right? As an accumulation investor, you have a long-term time horizon. You want down markets because you're buying. And in theory, if you're not retiring for 10 years, you're buying for the next 10 years. So hoorah. But as you get closer to needing the money, you start to have those multiple time frames. So you want to adjust to those, just like you probably have an emergency fund right now. Because I don't know how long this is going to last, Tony. I don't know if this is going to be deflation, hyperinflation, the 1970s of flat markets from 68 to 70 or 83. I don't know. But it is important you have a strategy that makes sense given where you're at. And I only know how to do that through having a plan of record with some process. And so it sounds like your plan of record right now has been, to use your phrase, pumping money into your 401k. And that is a good accumulation plan. But it sounds like you're getting closer to thinking about retirement. So maybe you need to get a little bit more thoughtful on the bigger picture of what is my plan for when I'm going to need this money, and then back into what your strategy should be for that plan. Because if it's getting closer, you do want to change how you allocate assets.
Totally agreed.
Yeah. I get the feeling. I know what you're saying. Hang in there is not very comforting, right? I would suggest, and I remember, Tanya, when I went through this in the COVID bear market, I think it's important that you do something, but you want to be very intentional and incremental about what the thing is. When we went through the COVID bear market, which was super fast, I had probably 60 conversations in a few days. And the framework that I used was, this sucks, acknowledging what's happening, acknowledging that This is scary. And looking at whether we're okay. So number one is what's happening. Number two, acknowledging, yeah, this really sucks and I'm worried by or what for whatever reason. And then three, looking at, well, are we still okay and on a good trajectory? Acknowledging the good things. It's not all doom and gloom. And then lastly, having some action item. And I do think, Tony, it's important when you are going through this that you do choose an action. Now, that action should be incremental. When we're going through the COVID bear market, we confirmed that we were still on a good trajectory with each client in terms of their life. So we knew that, yes, this was scary, but it didn't impact the trajectory. But I had some clients that chose an action of canceling Netflix. Now, that sounds silly. It's not going to make a difference. But I do think it's important that you do have an action because that will help you retain agency, because just hold on, it will be okay is very disempowering. So I'm not saying yours is Netflix. It might be, like you said, Tanya, doing some tax loss harvesting, reassessing your risk tolerance given being closer to retirement. I would do some things incrementally, but definitely do something. All right. So now that we're done with that easy one, let's go on to another one here. Thanks for the question, Tony. This question is from Cammie, and it's a timing question, Tanya. My husband and I, age 63 and 62, are retiring April 30th. I am self-employed and working on my 2021 taxes. I can save $6,000 in income taxes on April 15th if I put the maximum in my individual 401k for 2021. And this is something I usually do. However, since we are retiring this year, we will be withdrawing from the individual 401k later in the year. Is there any difference in these tax rates that should guide me to contribute to the 401k and save taxes now and then withdraw later and pay taxes on it? Or just don't bother contributing since I know I'm going to be taking money out?
Well, so Cammie's question, I think the important thing to consider is what your tax situation, how different they are for each year. Because she's talking about putting the $6,000 in for last year, getting the deduction for, let's say, 2021 in this scenario. So if your 2021 tax scenario is you're working full time, well, then you probably really want to do that deduction. And then let's say in 2022, if you're drawing money out, if that's the intention, you're going to need money out of that account in the subsequent tax year. It just depends on what your 2022 tax year is. In my opinion, if you're working full time in 21, you're probably going to benefit from that $6,000. In 2022, your income will probably be less if you're retired, and therefore the $6,000 will cost you less in that particular year. But it's taxes, so it's very specific to each person's situation.
Yeah, and I think you just plan this out. Usually you just have to map it out, but you're right. You're going to get the tax deduction in the prior year, and then you may change your mind. So, Cammie, hopefully that gives you a framework. So now we have another question here, Tanya, on CDs related to elderly parents. I recently had to put my father in an assisted living. He receives Social Security and interest off of a CD, which is his fixed income. He has an excellent rate on his CD, so I hate to break it, but I need that money to pay for his assisted living because his fixed income won't cover it. Any advice on what to do with the CD? I wouldn't worry too much about the rate. I would worry about having enough liquidity so you didn't have to face issues like this. Because the interest rate, if this is an older CD, they're getting more, it's probably lower than what you get now, at least in treasury bills, but it's beside the point. My suggestion, I think, would be you want to make your life as simple as possible in managing this journey for your father. And you only have so much time and emotional and actual capacity to deal with all of this stuff. I don't really care what the CD rate is if it's causing you to have to think about that rather than self-care or care for your father or whatever else. So if you need to have the cash, break the CD, put the money in a decent money market, and don't think about it again, because
I completely agree.
Too important.
Yeah, I think by the time I've had clients helping parents do the same thing, by the time they get to that stage, liquidity is the priority, not necessarily a rate of return and how much money your money is making. And in fact, a lot of those clients end up just with everything in cash and money markets, because the reality is if you are in assisted living, cost of care is likely going to keep outpacing income at a much higher rate over time. So totally agree. Cashing it out, I would prefer the liquidity over the interest rate.
And it's one of those things that I'm not saying you couldn't eke out interest by keeping it there and doing something else and optimizing. So I just don't think it's that important, because the trade-off is you got to think about it and you got to manage it, and you got enough to manage and think about. So I'm being a little, I wouldn't worry about it with something that you're dealing with. Okay, I have another question. This is related to long-term care, so related to the last question. Hey, Roger, I just discovered your podcast recently, and it's great. Well, thanks, Dennis. I'm eagerly going back and listening to older episodes to learn as much as I can, which always amazes me. I'm currently 53, and my wife is 49. She has a defined benefit plan. I have a 403B as I work for a college. We are both hoping to retire around age 62. We don't really have any other retirement savings aside from what I mentioned. We do own a house, and while it's not likely to be paid off by the time we retire, I expect that we have a decent amount of equity in the house. So the question, Tanya, from Dennis, is around long-term care insurance. We have no children. The ability to provide for ourselves should either of us need long-term care is a constant worry. However, the cost of insurance, and even at our relatively young age, is just way too much for us to afford. I know premiums can be hiked substantially at any given time. And so Dennis is wondering if there are any good strategies for using retirement funds, such as a 403B, to self-fund long-term care costs. Or are there any insurance policies that are more affordable than traditional policies that give some measure of certainty? How do you navigate long-term care? Because Dennis articulates the worry of, we think our retirement works, but this could happen and we're not so sure. And the options don't seem to be that great. So how do you navigate this, Tanya?
Well, I'll tell you, I think a lot of people just really hope that the system will change and they roll the dice. And I'm not advocating that or saying it's right, but when I try to help walk clients through this kind of framework of decision-making around long-term care, usually they're a little bit older, and because they're closer to retirement or in retirement by then. And he mentions that it's not affordable. His initial question of, are there other insurance policies that might be better or something else to consider? In my opinion, at that age, nothing stands out to me as a good option. He talked about also, can you use your retirement self-fund care? And I would say that's what most people do, and not necessarily intentionally. It's just through a lack of decision-making over time, right? They just don't do anything about long-term care. So then eventually the decision is forced upon them and somebody's sick in the family. And the way that works is they just start writing a check out of their bank account. And if there's not enough money in the bank account, then they start taking money out of their retirement accounts in order to do that. Now, I'm not saying that's the right answer again, but I would say that's probably societally, that's probably the most common plan for funding long-term care. The colleges here in Minnesota, I know, do have some pretty decent long-term care planning options offered through the employer. If you are looking for the most affordable options, to me, that's usually the best place to start. But I think the larger question is, if you can't afford the insurance today, is there something else in your cash flow or your retirement planning that you need to be addressing in order to put yourself in a position to be able to afford the long-term care insurance, if in fact you do want to protect yourself from that kind of risk? Like, do you have a plan for retiring at 60 and making sure that you have enough assets and that they're protected in the event something happens to you? It seems like the long-term care insurance decision needs to be within the context of a bigger picture plan.
I think that's 100% correct in that insurance is one solution, right? Other solutions are self-funding, like you mentioned. Another one could be eventually doing a reverse mortgage of some type, or a HELOC, or things that we don't even know are there yet because you're young. And you've identified the risk. I think what we struggle with a lot is, how do we think through the risk in an organized way that feels comfortable that we thought through it? And I think a lot of times in long-term care is definitely one of those. I know in the club, that was our first decision pod of, okay, how do we think through long-term care in an organized way? So I think that would be of help for you. So step one would be, and I would write this out and make a little worksheet for yourself, is one, what is my experience with long-term care family-wise? Did my father have it? Did my grandparents have it? And do that on both sides. Just have that framework. Wow, if I was laid up, who would be around to help me? Right? You mentioned you don't have children. I have Spencer and Emma. I've told them they're my long-term care insurance, jokingly. But I have children that are close. So I would put that. I have some children close. Do they love me? Yes. Do I feel comfortable that they would want to help? Yes. Do I want them to help? Well, maybe not, right? So walk through that framework. Even going down to in the worksheet we have in the decision pod in the course is how far away are they? What are my friend network, right? Tanya's a great friend, but she lives in Duluth. I'm in Fort Worth. She's too far to help me. But I got, Billy down the street and we help him. We have that arrangement. So you do the qualitative stuff and then you go through the quantitative stuff like you were talking about. Well, what is my exposure? I'm worried about this potential risk. If an event happens, what does it do to my plan, right? Like you were saying, Tanya, you want to know what it does to your plan because maybe it impacts the plan, but not materially, and you're still okay. Or maybe it blows the whole thing up. You want to know. By creating, but that pre-assumes that you have a plan to begin with. That's a good framework to go through it. And then you look down the options. So whether you ultimately will buy long-term care insurance or not, I do recommend that people get quotes for traditional long-term care insurance and for a hybrid long-term care policy, which is a insurance-based. Get quotes so you can have more data because you may find out one, you're not insurable, or you may find out that it's not as expensive as you thought, or you could afford a certain amount, or you may decide this is not an option for me, but you've done it in an organized way. And I think that helps us with checking this box that we thought through it, even if we can't do anything. At least we know that we didn't wing it and that we thought through it in a thoughtful way. And that goes a long way. Even if there's no solution, at least you addressed it so you didn't wake up and say, man, I should have looked at this. We're going to have, I think in October, Tanya, Steve Kane back on the show from LTCI Partners, who is a sponsor of the show. We do suggest that you go to get quotes from them because they'll send you some free indications of what those are without any obligation. We're going to have Steve Kane on because I think Long-Term Care Awareness Month is like October or November. So you can listen to some of that. Maybe that'll help you as well. Tough one.
Good
That's a tough one.
Dennis.
Yeah. I know you and I don't have answers. It's a frustrating one. There's no answer. Mm-hmm. Okay. We got time for one more, right? This is from Steve with guidance on rebalancing. Big topic right now. I just got into listening to podcasts last summer and I've really enjoyed your shows, specifically in relation to upcoming retirement and how to prepare correctly. I have a quick question for you about a topic I'm still pretty foggy on regarding rebalancing my portfolios. Can you explain to me when it's best to do this and how often? And is it a good idea to do it more often when the markets are down, like the current month, or not? So how do you do rebalancing? I know how I do it, but how do you do your rebalancing policy?
So our policy is in normal markets, we rebalance once a year in the first quarter. That is based on a couple of different white papers written by Vanguard. You can find them right on Google. That indicate any more is, it's not wrong to do more. It's not wrong to do less, but that the best risk reward profile is annual rebalancing. So we do it once a year in the first quarter. We set our targets based on the average of a few different big firms' outlooks for the year. So we don't try to be super smart on the matter. We just take a bunch of super smart people and take the average of their opinions and apply that to that rebalance. And then we would do what's called an off-cycle rebalance. This is what's important for Steve. So we have a system. I'm not saying our system is the right system. This is the system we created. So Steve and whoever's, and the listeners, you would want to create your own system that's based on what you feel is right. Mine's based on this evidence put together by Vanguard. So then the off-cycle rebalances we've added are if the market's down by 10%, that's a trigger. And we check our portfolios to see if they're off by more than 3%. Because Vanguard's also done some research on this. If the targets, like if your stocks are supposed to be 60 and they're at 55 and bonds are at 45, well, then you sell 5 from bonds and you add it to stocks. So if the market's off by 10% and we see that the balances are off by 3% or more, then we would do a rebalance. And then we do the same check when the market's down 20%. But here's what I'll tell you. Oftentimes at that 10% mark, because we have 10% corrections pretty regularly, the 10% mark, it's usually not off by more than 3%. So that means the portfolios haven't really changed that much. But at the 20% mark, it's going to be a more common thing. But like right now, they're not. And I've been reviewing this for the last month or so since we hit that 20% mark, and they're not off by more than that 3% mark. So really, it would just be activity for activity's sake. So that's what we look for when we do a rebalance. What about you?
I think that key thing there that I heard is you have a very thought out process.
Right.
Which is, that could be your nickname too. Well thought out process, Tanya. Very similar. I'm much more loose on rebalancing than most. I think once a year is more than enough. And I've seen other studies that have compared everything from daily on to monthly or to annual, everything in between. And there's not much utility in doing it any quicker because you're going to have transaction costs, you're going to have time costs, you're going to have lots of things, tax cost.
Taxes. Yeah.
So no more than once a year, I think, is fine. And this actually sort of relates to Tony's question about terrifying markets, which they are. Tony, I'm totally terrified. I get it. I am. But I'm always that way. I'm like terrified Roger. If you rebalance, that is part of a bigger process, right? It is doing rebalancing pre-assumes, again, that you have, and I don't know if I'm using pre-assumes or just assumes, Nicole will tell me, assumes that you have a target allocation that you've thoughtfully put together, right? So if you have a target allocation and you come out a year, all rebalancing is looking at what your target is and looking at how it's changed, and then rebalancing to the target portfolio, because that target portfolio represents within asset allocation the risk reward trade-off that you've agreed to, that you're comfortable with. And to do asset allocation, this is probably more than you wanted, to do it successfully, you are constantly selling the things that you want to buy more of, the things that have done really well. You're constantly selling the things you want to buy more of and buy the things that you don't want to buy, the things that have done poorly, right? Because that's what's going to get you back to your rebalancing, which we don't think about that. And the key with a process is that you have a process that you can stick with. One is have a process that you're comfortable with. That's the best investment process. And then two, have one that you stick with. Because if you don't stick with it, you really don't have a process at all. And that would go to Tony as well, right?
Yes.
But to your point, Tanya, we may accelerate rebalancing. We don't do it quite as quickly as you do market-wise, but we reassess. Probably the bigger opportunity in down markets is tax loss harvesting. Like if I have a large cap growth fund or index, selling that one to realize a loss to buy one that's fairly similar, but not similar enough that it doesn't violate tax rules. That's probably the bigger opportunity.
We did that in March of 20 during COVID.
Yeah, we
used that as an opportunity to get rid of positions that clients might have previously had big gains in, but they weren't maybe the managers that we really wanted anymore, but we didn't want to create a big tax event. And that was a great opportunity. I mean, the market was down 30%. And so then you're able to replace the similar style investment. It's like you might sell a house when it's low, but if you buy another house right away, you're kind of benefiting on the buy side too. So I agree. Tax loss harvesting at that time is a super meaningful activity. We keep using the word terrifying too. And one thing I would want to share with the group or with the listeners, with Tony and I think it's Steve who just gave us this last one. Carl Richards just did a blog post. He does the behavior gap. And it says, security is a feeling, not a number. And I think that's something I've really been stressing with clients for the last 6 months or so as we've been going through this recent correction or bear market is, what does security look like for you? And you said this very well. You taking an action is warranted, but the action may have nothing to do with your investments. So I think that's an important thing to really clarify what exactly security looks like for a person, because it's a feeling, it's not a number. And sometimes there's no number that's ever going to make you feel good or secure enough. So you kind of got to uncover that for yourself.
Yeah, I think that's spot on. And Carl is very wise. And we've been talking about how to navigate this. It's not simple. It's human. It's definitely not a number thing. It's a human thing of how do you match processes to deal with uncertainty. So well said. Tanya, what's going on over there at Line Financial?
We are in summer mode, which means we're neck deep in some internal business projects, getting prepared for the fall review season.
Awesome.
And thrown in a vacation here and there. What about you?
About to head to Colorado, so work vacation is for me as well.
Very nice. I hope you and Shauna have a lovely time.
Yeah. All right. Well, let's go set a SMART sprint.
On your marks, get set.
And we're off to set a little baby step we can take in the next 7 days to not just rock retirement, but rock life. Okay, last week we had you update your net worth statement. That gives you a dashboard of all of your financial resources outside of, social capital and human capital. Now I want you to take maybe a half hour, a cup of coffee, go to the coffee shop, review your net worth statement. If you're married or have a partner, review it with them and spend some time thinking of what do we want to do between now and the end of the year from a financial perspective. Looking at your net worth statement, you may say, we should contribute to our health savings account and make sure we get that deduction. Or we should contribute to an IRA or a Roth or change our 401k contributions. Perhaps it would be, we should start to build up more cash reserves because we're feeling a little uncomfortable in inflation. So maybe we need a little bit more slack in the system. So maybe we redirect some of our savings to build up that emergency fund. So just go have a cup of coffee. Make it a proactive meeting, but come away with one or two things that are very specific that you can take action on before you go off and enjoy your weekend. I hope you enjoy the rest of your week. This is my rest week. No exercising. All I'm doing is stretching and foam rolling, which is a whole different kind of pain, by the way. I hope you have a wonderful week, and we'll talk soon. The opinions voiced in this podcast are for general information only and not intended to provide specific advice or recommendations for any individual. All performance reference is historical and does not guarantee future results. All indices are unmanaged and cannot be invested in directly. Make sure you consult your legal, tax, or financial advisor before making any decisions.